Welcome back. Today on the Byte-Size Brief, we're going deep on GameStop, ticker symbol GME. Now, if you've been anywhere on the internet over the last few years, you know this company generates a massive amount of noise. We're talking viral memes, charity auctions with staplers, even the CEO's underwear. It's a brand that absolutely commands attention. But today, we're stripping away all that internet culture. We're focusing entirely on the stark, objective financial reality of the company as we stand here, right now in May 2026. We're going to look at the hard numbers, their shifting strategy, and what it actually means for the future. And we literally have to begin with a single, absolutely crucial number, $9 billion. That is the sheer magnitude of GameStop's current cash and marketable securities pile. It's a completely fortified, fortress-like balance sheet, and honestly, it's going to serve as the central anchor for our entire deep dive today. This isn't some theoretical valuation we're talking about. This is cold, hard cash sitting in the bank, granting them immense operational flexibility in a really challenging retail landscape. But this brings us to the core mystery of this explainer. It's the ultimate juxtaposition, right? On one hand, GameStop kicked off 2026 by quietly closing hundreds of stores all over the globe. They've seen a 14% drop in top-line revenue. And yet, on the other hand, they're sitting on that perfectly fortified $9 billion mountain of cash. So how does a company with visibly shrinking traditional retail sales manage to hoard so much capital? And more importantly, what exactly is the plan for it? To answer that, we're going to logically deconstruct the whole situation. First, we'll do a reality check. Second, a look at their shifting business model. Third, we'll break down the latest Q4 fiscal 2025 financials. Then, we'll lay out the bull case, followed by the bear case and its structural risks. And finally, the future roadmap.
Okay, Section 1, the GameStop reality check.
To really understand GameStop today, we have to look way past the recent headlines. Yes, there are massive store closures, and yes, there's a proposed executive pay plan that could award CEO Ryan Cohen a whopping $35 billion compensation package, though only if he hits some almost unprecedented long-term growth targets. But we need to look at the physical pivot happening right now on the ground. We have to completely reframe how we think about this company. Old GameStop was a traditional video game retailer, heavily reliant on selling you physical plastic discs out of massive strip mall stores. New GameStop? It's transitioning into something else entirely. Think of it less as a software retailer and a lot more as a specialty hobby shop focused on high-margin collectibles and retro gaming, all wrapped up inside a cash-rich holding company structure.
Which leads us to Section 2, a shifting business model.
If they aren't relying solely on physical game discs anymore, how does GameStop actually make its money today? They're actively pivoting away from pure hardware and software and leaning hard into adjacent gaming culture. Just take a look at the Q4 fiscal 2025 revenue mix. Hardware is still the biggest chunk at 48.5%, but the really crucial shift is right there in the middle. Collectibles now make up a massive 33.1% of total revenue, while software has shrunk down to just 18.4%. And the reason software is shrinking so fast is pretty obvious: the sheer convenience of digital storefronts. Gamers are just downloading titles directly to their consoles, totally bypassing physical retail. To fight back, GameStop has leaned heavily into collectibles, a category that has absolutely surged, growing over 54% recently. This brilliantly shows why management is making this pivot. The collectibles market focuses strictly on tactile, physical, high-margin goods. We're talking graded Pokemon cards, sports cards, exclusive pop culture merch. Why is this so defensible? Because it is largely immune to digital disruption. I mean, you can't exactly download a physical graded trading card off Valve's Steam platform or the PlayStation Store. It requires a tangible, physical transaction, and that perfectly aligns with GameStop's legacy trade-in model and their existing brick-and-mortar footprint. Moving on to Section 3, profit versus revenue in the latest quarter. All right, let's get into the hard numbers from the recent Q4 fiscal 2025 earnings report released in early 2026. Let's walk through these metrics together. Revenue came in at $1.104 billion. Now, that actually missed Wall Street estimates and was down year over year. But hold on, look at the operating income, $135.2 million, and diluted earnings per share hit 22 cents. So, despite missing on top-line sales, they beat profitability expectations. How? By fundamentally changing their cost structure. By severely trimming their operational overhead and shifting their product mix to those higher margin items we just talked about, they extracted way more profit from fewer total sales. That resulted in a full-year net income of an impressive $418.4 million.
So the financial reality of GameStop right now is defined by this extreme tension. Sales are undeniably shrinking, down 14% year over year. But thanks to ruthless corporate efficiency, aggressive store closes, and that ongoing pivot to high-margin collectibles, they've somehow managed to push their gross margin up to 35%. They put their selling, general, and administrative expenses, their SG&A, on a really strict diet. They're proving they can actually manufacture profit even while the core business footprint shrinks. They are basically prioritizing survival and efficiency over raw, unprofitable growth.
Let's shift gears to Section 4, the bull case for GME. Putting all the internet hype aside for a second, let's look strictly at the fundamental metrics, pointing toward a potential upside. First up, GameStop has zero long-term debt. In a high-interest rate environment like the one we're navigating here in 2026, carrying no debt is an incredible structural advantage. They aren't burning cash just to service massive loans. Second, between January 20th and 23rd of 2026, board members and executives bought nearly $22 million worth of stock with their own money. When insiders purchase stock on the open market at that kind of scale, that acts as a massive signal of internal confidence. They clearly believe the current valuation doesn't fully reflect the company's underlying assets. Add in those severe SG&A cost reductions we just discussed, and that $9 billion in cash flexibility, and you've got a company with the runway to do almost whatever it wants, whether that means executing a massive acquisition or fully funding a total business pivot.
And you know, this mindset is driven entirely from the top down. CEO Ryan Cohen famously takes zero salary and receives no standard stock awards. That massive proposed compensation we mentioned earlier, it's entirely tied to astronomical future performance goals. He stated, "We're a company that treats shareholder capital as our own, because it is." For the bulls out there, this means leadership is structurally allergic to corporate bloat and is perfectly aligned with the everyday shareholder, treating literally every single dollar spent as a critical investment.
But we have to be objective here. Section 5, the bear case and risks.
We absolutely have to address the specific structural threats to the company's valuation. The bear case is built on some undeniable, heavy headwinds. First off, GameStop currently trades at a price-to-earnings ratio of 50.1 times. For context, the specialty retail sector average is around 11 times. That means the stock is priced for massive growth, rather than its current fundamental performance, making it highly vulnerable to sudden shifts in market sentiment. Furthermore, the structural decline of physical games is very real and it's accelerating. When a gamer buys a new title directly via digital download from Nintendo's eShop or Sony's PlayStation Network, GameStop is completely bypassed. They make $0 on that transaction. Zero. Combine that digital dominance with a complete lack of forward guidance from management, and the risks are heavily magnified. The market hates a lack of guidance because it creates a vacuum of uncertainty. Without clear revenue targets from leadership, institutional investors are just forced to guess, and that drastically increases volatility.
To really visualize the extent of that risk, just consider this number, 3,203. That is GameStop's current global store count as of early 2026. Just a few short years ago, that number was well over 5,100. It's a stark illustration of the painful reality of their retail contraction. They've entirely exited certain countries and steadily closed hundreds of underperforming locations. Now, while this definitely helps margins in the short term, the core warning from the bears remains absolute. You simply cannot just shrink your way to long-term growth forever.
Section 6. The future roadmap. So what actually happens next? How does this tension between a shrinking core business and a massive cash pile resolve itself? Well, here's what investors and analysts are watching for right now. The most critical immediate catalyst is the upcoming Q1 fiscal 2026 earnings report expected in June. Because GameStop hasn't provided forward guidance, the market is just desperate to see if top-line revenue can stabilize. Beyond that, everyone is waiting for capital allocation announcements. Will they announce a dividend, maybe a massive stock buyback, or perhaps a major acquisition in the broader consumer or gaming space to combat those ongoing digital shifts?
Ultimately, the entire future of the company hinges on this single massive question. What will GameStop do with $9 billion? They've bought themselves incredible optionality, but the clock is ticking to deploy it effectively. That wraps up today's deep dive on GameStop, GME. For a sharper, more candid discussion, join us on the full audio explainer. Drop your questions and takes in the comments. We read everyone.